typically in a controlled manner. They distribute their shares to the retail traders who are jumping in, eager to open new positions at higher valuations. This influx can sustain the rally for a while. This AMD concept emphasizes that recognizing these phases is essential for successful trading. By understanding when smart money accumulates, manipulates, and distributes, traders can align themselves with the dominant forces rather than getting caught on the wrong side of things. So, this is the whole concept behind inducements also. There are other significance of inducements which we will talk about in a short while. Now, how exactly can we find inducements in the charts? What are the things that we need to consider? So there are two methods which you can apply to find inducements, both of which has certain limitations of its own. These are the first pullback method and the trendline method. Let's talk about the first pullback method. This is actually the first pullback after a break of structure. The idea is quite simple. An inducement is considered as the first pullback after a valid break of structure has happened. These pullbacks are minor pullbacks or internal pullbacks which can be formed using a single candle, a group of candles, or even a deep wick. You can see the different types of pullbacks that you can find on charts here. Even though we consider inducements as the first pullback after a valid break of structure, in certain scenarios, we might need to tweak this rule by a little bit. Let us understand this using a few examples. We will first consider some bullish market scenarios on a major market structure. Before that, make sure you have a fair understanding about the market structure mapping. You can watch that video in my SMC playlist. Anyways, here we have 4 situations. We will take a detailed look at each one of them. In the first case, we can see the price break and close above the previous major swing high. This is our valid break of structure. Now let us see what happened after the break of structure. You can notice how the price moved higher and then it formed a minor pullback. As per our definition, the low of this minor pullback is our inducement level. We can draw a small horizontal line at this low to mark the inducement. For easy identification of this line in the future, we can name this line as IDM, or you can even use a dollar sign for the same purpose. Now you can see what happened next. The price moved lower and break below this inducement line. This means that the liquidity below the inducement level has been absorbed or the uninformed retail traders are trapped. Only when the inducement level is taken out should we start thinking about a trade. Mostly, the market will move in the direction of the existing market trend after taking out the inducement. But this does not have to happen immediately. The price can reverse after sweeping a liquidity area, or it can reverse from an order block also. So inducement is a useful concept before taking a continuation trade. But as always, this cannot be said with 100% accuracy. There can be such instances where the market could just fall lower and break below the major swing low and thereby forming a change of character instead. Now moving on to the second example, in this case, we can observe that the price moved higher and it break above the previous swing high level. But the price did not manage to close above the previous higher high. So this is not a valid break of structure. Therefore, we cannot spot the inducement yet. And what happened afterwards? The price did manage to break and close above the previous major swing high level. So now we have a valid break of structure. Now the price moved even higher and formed a minor pullback. Now we can mark the low of this pullback using a line. This is our inducement level, which is denoted by IDM or a dollar sign. But as you can see, the price did return back to take out the liquidity below this inducement level. Keep in mind that only after the inducement is taken out should we think about taking trades from an order block or from an area of liquidity. Inducement is also used as an order block filter. The idea is that inducement levels are considered as smart money traps because it induces retail traders to take a short trade from an inducement level which is above the price of interest or demand zone during a bullish market structure, thereby making them to trade in the wrong location as well as in the wrong direction. For those who are unaware of what price of interest is, POI or price of interest is a price level or a price zone where there is a very good probability that the market could react with it and respond accordingly. A POI is also called DP or decision point by some experts. So a POI can be any of the following. It could be an order flow, an order block, a supply or demand zone, session highs or lows, daily or weekly or yearly highs and lows, or it could even be price caps. In a similar manner, inducement persuades retail traders to enter into a long trade position from an inducement level, which is below a price of interest or a supply zone during a bearish market structure, thereby making them to trade in the wrong location and in the wrong direction. So most often or not, price will break this inducement level and take out the retailer liquidity. So this is a very common smart money trap. And this is why it is always recommended to take trades once the liquidity associated with an inducement level is taken out. Because once the price has swept the liquidity associated with an inducement level, there are good chances that the price can reverse without testing any price of interest or supply or demand zones. I hope things are making sense. Now look at this third example. Where is the inducement in this case? It is clear that the price did form a valid break of structure, but as per our definition of inducement, the price did not create any minor pullbacks after the bullish break of structure. But the price did form a pullback just before the break of structure. So in such instances where there is no pullback formed after the break of structure, we will consider the last minor pullback before the break of structure as the inducement level. And we can mark it using a line and name it. Now look what happened next. The price did return all the way down and took out the liquidity below the inducement level, and then it moved higher. So this is a special case where we have to make adjustments and not blindly follow the textbook definition of inducements. Now take a good look at this last example. Here the price gave a clean breakout above the previous higher high. So it is a valid bullish break of structure. Then the price moves higher and forms a minor pullback. So as per our rule, we will draw a line at the low of this pullback and mark it as our inducement. Now did the price return to grab the liquidity? No, the price did not come back. Instead, the market moved higher and then it formed another minor pullback. Now what will we do? If such a case takes place, we should shift one inducement level forward to the low of this newly formed pullback. And even if the price don't take out this new inducement level and it moves higher and then create another pullback, then without any doubt, we should shift our inducement line to this new law formed. This is yet another important concept in connection with the basic rule of first pullback. And as you can see, the price returned to sweep the liquidity below the inducement level, and then the market continued higher after absorbing all the liquidity. The idea remains same for bearish instances also. Let's quickly look at a few examples for bearish market structure. In the first example, price formed a valid break of structure. Then it moved lower and made a minor pullback. So as per the rule, we can draw a line at the high of the pullback and mark it as the inducement level. The price did come back and sweep the liquidity above this line. Moving on to the second example, here the market did not give a valid break of structure at first. Then price consolidated a bit and then finally it break and close below the previous swing low level, thereby forming a valid bearish break of structure. And then once it moved lower, it formed a minor pullback. We can mark the high of this pullback as our inducement. Then we can see that the price returned to take out the liquidity above the inducement level. So an important point to be noted here is that you should never look for an inducement until there is a valid break of structure. Now in this third example, the price created a valid bearish break of structure, but the price did not form any minor pullback on the way down. Instead, it formed a corrective move towards the upside. In such cases, we can mark the high of the last pullback before the break of structure as our valid inducement level. In this scenario, you can see how the price moved higher and took out the liquidity above our inducement level and then fell lower. In the last example, the market formed a minor pullback after a valid break of structure. Then we can mark the high of this pullback as our inducement level. But the price declined even lower without grabbing the liquidity. Then it formed another minor pullback on the way down. In this case, we can shift our inducement line to the high of this newly formed pullback. And we can notice what has happened afterwards. The price swept the retailer liquidity above this inducement level. Now, let me remind you again that you should never think about taking a trade until and unless the inducement level is not taken out. This is mandatory if you are following smart money concepts. Now, always keep in mind that inducements should be marked on the impulse move that caused the break of structure. It should not be marked on the corrective move like in this case. This is the wrong approach. The only exception is when the market forms a valid change of character, in which case the correction move gets converted into the impulse move of the counter trend. Take a look at this scenario. Here, the price break and close below the previous higher low level, thereby confirming a bearish change of character. In this instance, we have to look for inducements in the price move that has caused the change of character. In that sense, we have to mark the inducement at the high of the first minor pullback after the valid bearish change of character. So make sure you are marking your inducements in the right manner. Another importance of inducement is that it helps to identify and confirm the higher highs in a bullish market structure, and it helps to confirm the lower swing lows in case of a downward market structure. In the market structure mapping episode, I have mentioned that you need a deep pullback after a valid break of structure to confirm your higher highs in case of a bullish trend, and also to confirm your lower swing lows in case of a bearish structure. I asked you to use Fibonacci retracements to identify deep pullbacks, but this is a time-consuming process. So a rather simple hack is just to identify the valid inducement level. Then the highest point above this inducement line, once its liquidity is taken out, will be our higher high in case of a bullish market structure. Similarly, the lowest point below the inducement level, once the liquidity above the inducement is grabbed, will be our lower swing low in case of a bearish market structure. Now let's talk about the second method of identifying and marking inducements, which is by using trend lines. The idea is very simple. Let us consider a bullish market scenario. Keep in mind, whatever happens, we will look for inducements only after a valid break of structure. Here you can see how the price break and close above the previous higher high, thereby forming a valid bullish break of structure. Then the market moved higher. What we will do is that we will draw a trend line connecting all the minor lows within the major swing. Or in other words, we will try to connect all the internal swing lows using a trend line, as you can see in this figure. Then we will wait for the price to break and close below the trend line, which will in turn induce retail traders to sell because of a trend line breakdown. All these retailers will be trapped and their orders will be taken out. Now, in a bearish market structure, we should look for a valid bearish break of structure below the previous swing low level. And when the price falls lower, we can mark all internal highs formed after the recent swing high and then connect all these minor highs as and when they are formed. And when the price breaks and closes above this downward trend line, we can expect retail traders to take buy positions as they have spotted a trend line breakout. This is our inducement. All these retail traders will be trapped and their orders will be absorbed. Now there are a few problems with this trend line method. First of all, trend lines are subjected to human errors. This means different traders would draw and interpret trend lines differently. So the inducement identification varies vastly from person to person. So this confusion is not a good thing. The second issue is that sometimes even after a breakout below the trend line, the price would not move below the inducement low, which means the liquidity below this level is not absorbed. This could lead to wrong analysis because as per our pullback method, the inducement level gets shifted to newly formed pullback lows as long as the liquidity is not swept by the market. So from my experience, it is better if you stick with the first pullback method after a valid break of structure for marking your inducements. Now let us talk about major and minor inducements. You might have already guessed what these are. Anyways, the differentiating factor between the major and minor inducements are the time frames. It will also depend on your trading style. So if you are an intraday trader, then your higher time frame can be 15 minutes, while your lower time frame can be between 1 minute to 5 minutes. So if you were to map your market structure and mark your inducements on a 15-minute higher time frame, then you are indeed marking the major inducements. Now, if you start mapping the structure and mark all the inducements on a 5-minute lower time frame, and then consider all the internal price swings and the associated break of structures, then you're drawing the minor inducements. On a similar note, if you are a swing trader, then your high time frame can be 1 day or 4 hours, whatever it may be, and your low time frame could be 1 hour. In this scenario, your major inducement is marked on your higher time frame major or external structure, while your minor inducement is marked on your lower time frame structure, which is 1 hour, and considering all the internal price moves within the major swing structure. Now, the idea of identifying and marking minor inducements are also the same as with major inducements. But because we are making use of lower time frames and also taking into consideration the minor or internal structure, we will be faced with a lot of minor structure breaks. This will result in a lot of inducements getting formed. These minor inducements can be helpful for those traders who wants to collect some quick profits while waiting for the price to take out the major inducement level. But there is a small change in concept when it comes to minor inducements and change of character in a lower time frame internal market structure. So let's clear that out. So this is a bullish market structure on a higher time frame, and to the right is how the lower time frame structure looks like. And as you can clearly see, in the lower time frame, the internal price swings are quite detailed and visible. Now let us mark the break-off structures in the minor time frame. Once the break-off structures are identified, let us find the proper inducements. We will try to mark the inducements as per the first pullback after the break-off structure rule. Now since we have marked the bullish break-off structure, we will have to spot the lows of the first pullback. Here I have marked all the lows of the pullback, and we can draw a line at these lows. These are our inducements. Now we can see how the price reacted in these inducement levels. Now let us focus our attention on this last inducement level before the market reversed lower. So before it reversed, the price tested a supply zone or a price of interest. So this is not really an inducement, but instead this is a change of character or chalk in the minor structure. So the symbol difference between an inducement and a chalk in a minor structure on a lower time frame is that inducement is the first pullback after a valid break-off structure, but a chalk becomes that inducement level before the market tests a price of interest. Let us look at a bearish case also to help us understand the idea even better. So first, you need to go to your higher time frame and map the structure. That is, you need to find your lower highs, lower lows, break-off structures and change of characters if any. Then, you need to mark the major inducements in this higher time frame structure. So if you are an intraday trader, map your structure on the 15 minutes higher time frame. The next step is to move to your lower time frame, which can be between 1 minute and 5 minutes. Let's take 3 minutes for our purpose. In the 3 minutes chart, you will get more granular details on the internal structure and a lot more of swings. Now start identifying the valid minor break-off structures when the price break and close below the previous internal lows. Then start identifying the minor inducements, which are actually the highs of the first pullback after a valid minor break-off structure. Now this last inducement before the price reversed after testing a price of interest or a demand zone will be our change of character. So in the market, change of character can happen on two occasions. First of all, as you may already know, a chalk happens on a major market structure when the price breaks and closes below the previous major swing low in case of a bullish market, resulting in a bearish change of character, or we can say there is a change of sentiment from bullish to bearish. It can also occur when price break and close above a previous major lower swing high level, resulting in a bullish change of character. The second scenario where a change of character can be identified is on a lower time frame internal structure where your inducement becomes a change of character when it tests a price of interest and reverses. I hope things are clear. So these are all the important things that you need to know about inducements as an SMC trader. Inducement is one of the most vital liquidity concept in the whole of SMC course. So make sure you learn the concept properly, practice it on different charts, backtest it to find out if it actually works for you, and take trades to get comfortable using it. In this video, we are going to learn two important topics in SMC. They are order flow and order blocks. These are related topics, so it makes sense to make a single comprehensive video on these topics so that we can learn how they are different from one another. Now let me warn you, this is going to be the longest video in this entire course. So watch it when you have adequate time because this is one of the most demanded smart money videos. In the previous episodes, we have discussed the concepts of liquidity in great detail, which is actually the core of SMC learning. And if you haven't watched these episodes, I strongly urge you to watch them right away. Now, a fair understanding on liquidity will give you a lot of insights into the ways which smart money institutions operate. But that is not enough to convert into profitable trade setups. For getting the best possible trades, you need to have a fair idea as to where to take the entries. This is where order flow and order block come into the equation. These are simple yet effective methods by which you can spot potential areas from which you can hop into a trade position with minimal risk and high chances of profits. So in this episode, we are going to start our discussion with order flow, how to identify an order flow in charts, what are the different types of order flows and how do they work. Then we will discuss about order blocks. Why is it important to have an order block? How to spot an order block, the different types of order blocks, and what are all the key points that you need to keep in mind. And we will also learn how to identify a valid order block. We will not talk about order block refinement in this video. We will cover it in a separate video. So watch this video till the end so that you will not miss any important aspect. And if you appreciate our work in creating valuable content free of cost, make sure to like and share this video. And if you are new to this channel or you haven't already subscribed, do make sure to subscribe and also enable the bell notification so that you will never miss any upcoming update. So without wasting any time, let's get started. We will begin with the order flow. I have told you in the liquidity videos that market moves from one area of liquidity to the other. This can either be internal or minor liquidity or external or major liquidity. The market can tap into either of these liquidity areas or zones and then reverse the price direction after sweeping the retailer orders. In the charts, a lot of such liquidity areas are generated, and it is obvious that not all of them are worth considering, and only a few of them will provide us with high quality trade setups. So how are we going to capitalize on our knowledge in order to make highly probable and profitable trades while reducing the risk of overtrading or simply getting into trades at all these liquidity areas? This is where order flow and order blocks come into the picture. So think of an order flow as that price move in the chart which to most extent reveals where the smart money hides their positions or where they are most likely to initiate their positions. If you have observed the flow of prices in the market structure, you will notice that the price will not always tap into the external structure before reversing its direction. The market might reverse even before that. This is due to the existence of order flows. Technically, there are two types of order flows. These are bullish order flow formed during an upward market structure and a bearish order flow which is formed during a bearish market structure. I have said this many times, but I will say it again, that you need to have a good understanding as to how to mark the market structure properly in order to make the best use of these concepts. If you get your market structure mapping wrong, everything else will meet the same fate. So make sure to watch the first episode if you haven't already. Now coming back to our discussion, let us consider a bullish market structure and try to spot the order flow. During a bullish market, the major price structure forms higher highs and higher lows. But if you observe the corrective moves, you will notice that it forms lower highs and lower lows. So a bullish order flow is represented by the last selling price before the bullish price momentum. Or in simple terms, the last selling move before the buy is called as the bullish order flow. Therefore, all you have to do is to identify the bearish candles before the price begins to move higher. This is how we spot bullish order flows in the charts. Let us now learn how to spot a bearish order flow. You will find bearish order flow in a bearish market structure. In a bear market, the major structure forms lower highs and lower lows, while the corrective moves forms higher highs and higher lows. And the bearish order flow is represented by the last buying price move before the ongoing bearish price momentum. Or in other words, the last buying move before the drop or sell is called as a bearish order flow. Therefore, you need to identify the bullish candles before the price begins to drop lower. But is the order flow that we have identified a valid one? This is a question which is very important to consider. Order flows can be classified into three types. These are mitigated order flows, unmitigated order flows, and failed order flows. Out of these three, only the unmitigated order flows are of any use to us. But for the sake of understanding, I will explain all of them. Basically, a mitigated order flow is one where the price has already tested or mitigated the order flow. Think of an order flow or even an order block as a one-time use thing. Once it is tested or mitigated, it is of no use to us anymore. It is not like our typical supports or resistances where the price will respect it multiple times. But this is not the case with order flows and order blocks. Check out this example. We have identified the last selling move before the buy. So technically, this area is an order flow. But if you notice closely, you will see that the price has tapped into the bullish order flow. Therefore, this bullish order flow is mitigated by prices. This means that the order flow will not work in the future. Look at another example, but this is for a bearish structure. We can spot the last buying move before the drop and mark this area as a bearish order flow. Then you will notice that the price has tapped into this order flow and therefore it is already mitigated. So this order flow will not work for the future price moves and it is not worth considering. The second type is unmitigated order flow. In this case, the price will not tap into the order flow or the price will not mitigate the order flow. These are the order flows which are useful to us. This is because there is a high probability that the price might return back to mitigate this order flow. Now we can take a few examples to understand this better. In this first case, the market is in a bullish trend. So during the corrective move, the price forms lower lows and lower highs. Our order flow will be the last selling move before the buy. Once we have marked the order flow, we can observe that the price has not tested or mitigated this bullish order flow. It also means that the price could come back to this order flow later to mitigate it. So this is an unmitigated order flow. Similarly, if we spot a bearish order flow in a bearish market structure and the order flow is not tested or mitigated by prices, then this is an unmitigated order flow zone, which could be a potential area of interest for a price reversal in the future. Now keep in mind that even the wicks projecting into an order flow zone mitigates it. So the tiniest of tiny details matter. Now what is a failed order flow? So it is an order flow which we have identified and marked through which the prices passes through. Just like a mitigated order flow, failed order flows are of no use to a trader. Another point to keep in mind is that once an order flow is mitigated, you can always shift towards the next one, and if the next one is also tested, then you can shift towards the next order flow and so on. Now, let us briefly look at how to take trades using the order flow concept. The idea is to take a trade from the order flow zone when price comes back to test the order flow during a pullback, which follows the break of structure, and then take a trade entry when the price begins to reverse from the order flow after mitigation. As I have mentioned a few times, this should only be applied to unmitigated order flows. If you know how to correctly mark the market structure and identify the pullbacks, then this is going to be very easy. Now let us consider an example for bullish and bearish scenarios. This is a bullish market structure. Here you can see that the price has created a bullish break of structure when it broke above the previous major swing high. We can identify the unmitigated order flow by using the method that we have learned. Now we have to wait for a valid pullback to happen. And as you can see, the pullback returned to our unmitigated order flow and tested it. By now, we can anticipate two outcomes to happen. Either the price can break below our order flow, forming a failed order flow resulting in no trades, or the price can test the order flow and reverse its direction to move along with the major bullish structure. If it were the second scenario, we can take a long trade above the bullish order flow while keeping the stop loss below the order flow zone. Our minimum target should be the most recent swing high or the major higher high level. In a similar manner, we can discuss the scenario for a bearish market structure. As you can see, the price has formed a bearish break of structure when it broke below the previous major swing low level. We can mark the unmitigated order flow zone here. Then, we will have to wait for a valid pullback to happen. We can observe that the pullback returned to test the unmitigated order flow. As in the previous scenario, two outcomes are possible. First, the price could just break past the order flow, resulting in no trade. The other scenario is when the price tests the bearish unmitigated order flow and reverse lower to move in the existing major market direction, which is bearish. In that case, we can look to take a short trade below the order flow after it has been mitigated while keeping our stop loss above the order flow zone. And our minimum target level should be the most recent swing low level or the lower low level. This order flow concept can also be applied to the minor market structures or in your lower time frame charts for the sake of taking short-term trades or for grabbing some quick points. I have marked out some bullish as well as bearish cases here. An important point to note is that if there are multiple unmitigated order flows formed within a major structure, then there is a high probability that the market will return back to the most extreme order flow while failing all other order flow areas. Or in other words, the extreme order flow zones have a higher probability of providing us with a successful trading opportunity. Now you can pause the video and take a note of the points mentioned, or else the video will get very long. I hope this will be useful for many scalpers and intraday traders who just wants to catch a few quick points. Now, there are a few drawbacks with order flows that all traders need to be aware of. First of all, stop losses will be considerably large. Since order flow is a zone or an area in the chart, we will have to place our stop loss beyond this zone or area. Even then, we cannot be absolutely sure that the price will not return to hit our stop loss. And because of a large stop loss, the reward to risk also reduces. The reward to risk provided by an order flow trading opportunity is lower compared to that given by an order block trading opportunity. Another problem with order flow is that there is no proper entry criteria. Entering a trade position from an order flow zone is mostly about our intuitions and reward to risk considerations. Yet another problem, which is committed due to human error, is the wrong identification and marking of order flow areas. If you make the mistake of marking the order flow wrongly, then most probably the price won't return to mitigate it, or sometimes it will even fail the order flow. Now take a look at this case. Tell me where to mark the order flow area. By definition, a bullish order flow is the last selling move before the buy. So if you follow this definition blindly, then we will mark this area as the order flow. But this is not the correct order flow zone. The area that we have highlighted is just an internal move or consolidation. The real order flow is this whole selling move. The reason why I say this is because the consolidation did not take out the low of the selling move. If it would have taken out the previous low, then there is no issues with considering it as an order flow. And you can see how the price returned to test the order flow. Similarly, while marking a bearish order flow, which is the last buying move before the sell, you have to make sure if the move is just an internal move or consolidation, or is it actually taking out the high of the previous move. Now, let us shift our attention to order blocks. Order blocks are considered as a refinement of an order flow. Order blocks eliminates a lot of issues that an order flow had. Order blocks provide you with limited trades which are of high quality and have a high probability of success. Secondly, the reward to risk ratio is largely improved when using order blocks. This means the stop loss setting is much tighter. The trade entries are also more optimized due to the limited number of trades on offer. But on the downside, a tight stop loss can be taken out by volatile price swings. Let us first learn the textbook definition of order blocks and how to identify and mark the order blocks. In a bullish market scenario, a bullish order block is identified as the last bearish candle before the buy. And during a bearish market structure, a bearish order flow is considered as the last bullish candle before the sell. So you have to spot the last bullish or bearish candle before an impulse price move and mark its highs and lows. This is considered as an order block by most stock market teachers, aka gurus. If you follow this logic and start marking order blocks, you'll be shocked to notice that there will be a large number of order blocks on the charts, and you'll obviously be confused as to which order blocks will work and which won't. This is a vague way of explaining what an order block is, and it is of very little use to a trader. The majority of order blocks obtained using this method is useless and it won't work. To identify and mark only valid and high probability order blocks, I will introduce you to 7 important factors. These are concepts that you have already learned in the previous episodes of this SMC course, so it is nothing new and you don't need to stress about it a lot. Here are the 7 factors. The first point is that you should mark order blocks on higher time frames only. So if you are an intraday player, then 15 minutes can be your higher time frame and you should mark your order blocks on this time frame only. Second one is that there should be a valid break of structure. The third thing is to look for the last buying candle before the sell for a bearish market structure and look for the last selling candle before the buy for a bullish market structure. But certain conditions apply to this step. The fourth factor to notice is that there should be an imbalance or a fair value gap. Another important thing to look out for is that there should be a proper inducement after the break of structure. This is to avoid falling into the smart money trap. Next point is that there should be a proper liquidity sweep of the previous highs or previous lows depending on the market structure. And the final thing to check for is to see whether the order block is associated with an unmitigated order flow. Now, if you manage to identify and mark order blocks based on these 7 factors, Then you will come to the realization that there can only be a maximum of 2 valid order blocks within a certain swing move. Also, the minimum number of order blocks within a swing move is 1. We will learn about these 2 valid order blocks very soon. But first, let us discuss in great detail about the 7 factors for identifying and marking valid order blocks. So the first factor is time frame. I have mentioned at the beginning of this course that structure mapping has to be done on higher time frames and trade entries are to be taken on lower time frames depending on your trading style. Similar logic applies to order blocks also. The order blocks are to be identified and marked on your higher time frame charts. These order blocks will be lower in number and has a higher chance of success compared to those order blocks marked on lower time frames. Once the higher time frame order blocks are marked, then we can turn to our lower time frame charts to refine our order block for better entry prices. For example, if you are an intraday trader, then you can mark valid order blocks on your higher time frame, which is 15 minutes. And once you're done with marking the order blocks, you can go down to your lower time frames such as 1 minute, 2 minute, or even 3 minute charts and refine your order block for taking better trade entries. This is called lower time frame order flow refinement. This method will help you analyze the trend and take positions with better reward to risk. Now the second factor is to have a valid break of structure. The market should form a valid break of structure before we can actually start to spot and mark the order blocks. Order blocks are not valid until and unless there is a proper break of structure or a change of character in prices. You may already be familiar with how to mark the market structure by identifying bows and chalk. I won't go into all those details. You can always go back and watch the comprehensive video on market structure mapping. Anyways, during a bullish market structure forming higher highs and higher lows, we will only start to look for order blocks when the price has broken and closed above the previous swing high level. In this case, we will look for bullish order blocks since the overall idea is to ride the existing trend. But in case if the market has broken down and closed below the previous major higher swing low level, which results in a bearish break of character, then we will look for bearish order blocks only. But a valid break of structure or a change of character is not the only metric to confirm before spotting the order blocks. We also need to check for inducements. I have seen traders mark bearish order blocks on bullish market trends and vice versa on bearish trending markets. They are literally trying to grab the minor or internal swing moves. This may work on some occasions, but most often the price ends up breaking through these low probability order blocks. Marking order blocks on a higher time frame and then refining it on lower time frame is one thing, but marking counter order blocks against the existing market structure can result in big losses. So I will never ask you to bet against the market. In fact, it is the wrong approach. In a similar manner, you should only mark order blocks once the price has broken and closed below the previous major lower swing low level. This is a valid bearish break of structure, and for this instance, we will only look to identify and mark bearish order blocks. And if the price has broken and closed above the previous lower swing high level, which is a bullish change of character, then we will look for bullish order blocks. I hope things are making sense. We have already discussed about the third point, but still certain things need more clarification. So in order to identify a bullish order block, you will have to find the last bearish candle before the buy. But it is not so straightforward. There are other things that you need to look for. The point is to check if there is a liquidity sweep involved. This means that the last candle that we have spotted should take out the previous minor low formed. This also means that next candle should not take out the low of our last selling candle. Now, if you are unaware of what liquidity and liquidity sweep are, then I suggest you to watch my videos on the same topic. So if the last selling candle was unable to take out the previous liquidity, or if the succeeding candles take out the low of our last selling candle, then we will not consider this candle for marking our bullish order block. In addition to this, an imbalance should be formed after our last selling candle is formed in case of a bullish structure. So technically there should be a fair value gap between the high of our last selling candle and the low of the third candle when counted from our last selling candle. It does not matter if this imbalance is wide or narrow. The only condition is that there should be an imbalance between these two candles. As I have mentioned earlier, we should only start checking for order blocks and imbalances only after a valid break of structure or a change of character in the swing structure. If any of these two conditions are not met, then our bullish order block is not a valid one. So if there was no liquidity sweep, then we can shift our order block to that candle which has actually taken out the liquidity or the previous minor low level. This indirectly means that while marking a valid order block, the color of the candle doesn't really matter. What matters is whether the minor liquidity was swept or not. Now, even if we have spotted the last candle which has taken out the liquidity at the previous minor low, if there is no imbalance between our marked candle and the third numbered candle, then we cannot mark this as a bullish order block. And even if there was an imbalance between the highs and lows of these candles, but if this imbalance is mitigated, then also we cannot mark our first candle as a bullish order block. So the fair value gap is the most important factor to consider while marking a valid order block. And once a liquidity sweep and an imbalance is confirmed, then we can mark the high and low of our first candle, which will become our bullish order block. Another interesting observation that might be useful is that once you have identified the last selling candle or the candle that have swept the liquidity of the previous minor low, and if the succeeding candles are formed within the highs and lows of this first candle, then these candles don't really have any importance and these are just internal consolidations. In this case, we will only consider the candle which breaks the high of our first candle, and this will be our second candle. You can then check for imbalance between these three candles and not take into account the consolidating candles. I have talked about imbalances and also about such internal consolidations in my fair value gap episode, so you can check that video to know more. The logic remains the same while marking a bearish order block in a bearish market structure after a valid breakout structure. I won't go deep into all the details here. As always, the first step is to ensure that there is a valid bearish breakout structure. Then you have to look for the last buying candle before the sell. Make sure that this candle has taken out the previous minor high. If it is not the case, you can shift towards the right to find that candle which has swept the previous minor high level. So the color of the candle doesn't really matter when marking the order blocks. What matters is this liquidity sweep. The next factor after this is to check whether there is an imbalance or a fair value gap between the first candle's low that we have identified and the third candle's high. If there is no imbalance or gap between them, then the order flow is not valid at all. But if there is an imbalance between the first candle's low and the third candle's high, then we can mark the order block by drawing lines at the highs and lows of the first candle that we have identified. In some cases, multiple internal consolidating candles can be formed within these highs and lows of our liquidity grabbing candle. You don't have to consider these candles. I have already stated the reason as to why this is so. You can mark the candle which breaks the low of our first candle as the second candle for the imbalance identification. This is how you spot and mark a bearish order block properly. But to filter the best order blocks, you need to consider more factors. Earlier in this video, I have mentioned that there can be a minimum of one order block and a maximum of two order blocks between a swing high and a swing low. These are number 1, the extreme order block, and the second one is the decisional POI or the decisional order block. Both order block and POI or price of interest are used in a similar sense. Now both these types of order blocks work in the market if properly identified and marked. The extreme order block is considered the high probability OB because it is the last resort for price to make a reversal as there is enough liquidity and imbalance available. The reason why there can only be two valid order blocks can be either due to inducements or it can be due to order flow mitigations. I will explain both. Let me start with inducements. I have made a detailed video on inducements in the previous episode. Make sure to watch that video to get a proper idea on the topic. Anyways, inducement is considered as the first pullback after a valid breakout structure has happened. The pullback can be a minor one. If you observe in this figure, then the first pullback after the bullish breakout structure is marked using a line with a dollar sign. It is essential for price to take out this inducement. Only then we can identify our valid order blocks from the smart money traps. But as you can see here, the price moved higher without sweeping the inducement. The price formed another minor pullback. Keep in mind that the minor pullbacks can be a single bearish candle or a group of candles against the bullish price flow. When price forms a new pullback, then we will shift our inducement level at the low of this pullback. And if the price still moves higher without taking out the liquidity below this pullback's low, then once again we can shift our inducement level to the minor pullback formed at the higher level. And in this case, the market has taken out the inducement as the price has crossed below the pullback lows. Now I will tell you why this is important. See, during the minor pullback after a bullish break of structure, you can mark a bullish order block at one or more of these levels. But the bullish order block drawn at the highest pullback level is of low probability, and there are high chances that the market will come back to take out the liquidity and break below this order block and move lower. Many traders make the mistake of marking this order block, and when the price give a reaction near this order block, they initiate a long position. But the chances of this trade failing is very high. So this is not really an order block, but instead it is a trap, commonly known as the smart money trap. So no matter what the scenario, never try to take a trade until and unless you haven't confirmed that the inducement is taken out. Once the inducement is taken out, you can use the order flow mitigation rule to further filter order blocks if there are more than two of them. We will come to this in a short while. Meanwhile, let us understand inducement for a bearish market structure. In this case, the price did a bearish break of structure below the previous swing low, and then it formed a minor pullback higher. We will draw a line at the high of this pullback with a dollar symbol to mark the inducement level. And as you can see, market moved lower without taking out this inducement. Then it formed another minor pullback. So now we will shift our inducement level at this pullback high. Then you can notice how the price moved higher and grab the liquidity above this pullback level, or in other words, our inducement is taken out. Once the inducement level is taken, then we can look towards other order blocks for taking a trade. Now, if there are still multiple order blocks available even after applying all these rules, then we can further filter them using the order flow mitigation rule. This concept is very simple and easy to understand. You might already have an understanding of what an order flow is and how it works. So if I were to talk about a bullish market structure, then the last selling move before the buy or the impulse is our bullish order flow, and the last selling candle or that candle which has swept the liquidity of the previous minor low and having a fair value gap between them will be our bullish order block. This rule asks a trader to mark the order flow associated with an order block and then check if the order flow is mitigated or not. In case if the order flow is mitigated, then the order block associated with it will be of low probability, or it can also be neglected. And if the order flow is also unmitigated, then the order block and order flow are both high probability areas from which price can take a reversal. This filtration method using order flows will reduce the number of order blocks marked between a swing low and a high to a maximum of 2 and a minimum of 1. Now finally, let us summarize what we have learned. We will consider a bullish market scenario first. This is a one-day time frame of Euro-USD chart, but you can choose any chart on any time frame based on your trading style. Here you can see that the price has managed to break and close above the previous higher swing. So this is a valid bullish break of structure and we can name it. So the first condition is met. Now as the price moves higher, we need to look for the inducement levels. Inducements, as you are familiar with, are formed at the lows of the minor pullbacks being created, usually after a valid structure break. Here, as the price moves higher, it forms a minor pullback, the low of which we will draw a small horizontal line. The minor swing low is our inducement level. Now price moves higher once again without grabbing the liquidity below our inducement level. As the market moves up, prices forms another minor pullback. Based on our rule, we will now shift the inducement level to this newly formed swing high level. But once again, the market moved higher and formed another single candle pullback without sweeping the previous inducement. Again, we will have to shift the inducement level to this new minor low formed. You can clearly see how we should mark the inducement only on the impulse price move. Now finally, price makes a correction and takes out our inducement level. This implies two things. Number one, the highest price before the inducement sweep will become our higher high. Secondly, it also means that the price can now tap into any liquidity level or zone and probably reverse higher. This is also a go-ahead sign that we require to begin marking our order blocks. So start from the lowest point on the impulse price swing. For finding bullish order blocks, start finding the last bearish candle before the buy, which should necessarily take the liquidity below the minor swing low, and it should also be associated with an imbalance or a fair value gap, which is unmitigated. Now, based on these criteria, if we consider this bearish candle, then we would be marking the order block falsely. It is because this candle did not sweep the liquidity and there is neither an imbalance associated with it. The candle which absorbed the minor liquidity is the next bullish candle, and there is a fair value gap between this candle and the third candle, which is unmitigated. So we will have to shift our order block to this first bullish candle. We can mark the highs and lows of this candle, and this is our high probability extreme order block. You might have understood how the color of the candle is less significant in comparison to the liquidity grab and fair value gap criteria. As I have mentioned earlier, a maximum of only 2 order blocks are possible. Here you can see how this bearish candle sweeps out the liquidity below the previous minor low with its deep wicks. In addition, there is also an imbalance or inefficiency between the first and third candles, and it remains unmitigated. So this becomes our second order block. Just mark the highs and lows of this bearish candle. This is the decisional order block, which has a 50% chance of working. In addition to marking the order blocks, also make sure to draw the imbalances or fair value gaps associated with them. Now let's see how the price responded. Price moved lower and it took a reaction from the decisional POI or the decisional order block. It also mitigated the imbalance in that area. Now here's the thing, when presented with 2 order blocks, that is a decisional order block and an extreme order block, we should look to take a position from the extreme order block because this is a high probability order block than a decisional order block, and it also helps us to buy at discount prices. We will talk about premium and discounts in one of our upcoming videos. So here, the price took a reaction from the decisional order block, but then it break down below this order block. Keep in mind that the order flow and order blocks are just a one-time use thing. So we will neglect the decisional order block now. Then the price declined lower and it mitigated the imbalance and interestingly moved higher without taking our high probability extreme order block. One of the reasons why the order block was not tested was due to the fact that the bullish order flow, which is the last selling move before the buy that is associated with our extreme order block, was mitigated, as you can see here. It is one of those filters that you can apply to separate high probability order blocks from the low quality ones. In this scenario, since the price is at a discount valuation and since it filled the imbalance, we can look for long trading setups while keeping our stop loss below the order block area. If you are more risk averse, then you can even set your stop loss somewhere below the imbalance zone. All the minor swing highs will be our minor targets, but one major target will be the previously formed higher high. You can see how the price moved higher. Now let us look at a bearish scenario. This is a 1 hour time frame chart. Here you can see how the price reacted from the previous low level, but it failed to break below it. But after a slight pullback, price managed to break and close below the major swing low, thereby forming a valid bearish breakup structure. Once the breakup structure is confirmed, the next step is to find a proper inducement. Usually, inducement is the high of the first minor pullback after a bearish breakup structure. But here, price moved upwards. There is no inducement to be found lower. In such cases, inducement level becomes the high of the last minor pullback before the structure break. I will mark this level and you can observe how the price returned to absorb the liquidity above the inducement. Once the inducement sweep is confirmed, we can establish the lowest price point before the inducement grab as our lower low. In addition, we can expect the market to reverse from any liquidity zones and continue to decline lower. This also gives us a go-ahead signal to mark our order blocks. Let us start from the highest point of the impulse move that generated the structure break. By definition, a bearish order block is the last buying candle before the sell. In addition to this, it needs to sweep the liquidity above the minor highs and it should also be associated with an imbalance. Now this is the last buying candle, but it has not swept the liquidity. It was this bearish candle that has actually taken out the liquidity above the previous minor high. There is also an imbalance between the first red candle and the third candle. Above all, this imbalance is unmitigated. Now if we mark the order flow, we can see that it is also unmitigated. Therefore, we can mark the high and low of this first bearish candle as our valid bearish order block. This is a high probability extreme order block. Now we will see if there is another order block available. If you look at this particular candle, you can notice how it has taken out the previous minor highs. It is also associated with an imbalance which is unmitigated. So this green candle can be our second order block. We can mark its highs and lows. So it becomes our decisional order block. We can also mark the order flow for additional filtering. We can find that the order flow is also unmitigated. But keep in mind that the extreme order block has a higher probability of success than the decisional order block. Now let's see how the price reacted. First, the price moved higher, mitigated the imbalance, and tested the decisional order block. But it did not reverse. Instead, the price moved upwards, first mitigating the inefficiency there. Then the price moved into the order block. But instead of just testing this extreme order block, price break through the order block. During such an instance, most market participants would expect a change of character. But someone who knows deeply about liquidity and manipulation, they would wait for the price action to complete. And as expected, the price did not break and close above the previous swing high. Instead, it was sweeping the external liquidity available above this major swing high, which is none other than retail stop losses and breakout limit orders. Now the market absorbed the liquidity and closed below our extreme order block. So this order block is still valid. The traders can look for short trades from within the order block, and they can set the stop loss above the order block, or they can even place the stop loss above the wick of the manipulation candle. This is a good location to sell because we are shorting at a premium valuation. All the previous minor lows are potential target levels, but the major take profit level will be a previous lower low level. So that is all you need to know about order blocks and order flows. By now, we have covered a lot of important topics in SMC, from structure mapping, liquidity, inducements, to order flows and order blocks. In this episode, we will focus our attention on one of the common manipulation methods in the market. Market manipulation is the cause for losses of many retail traders. But still, there are some proactive traders who trade with this manipulation and they grow their small accounts with the smart money. If you know how the market behaves, you can easily identify the possible manipulation areas for taking advantage of. The manipulation concept that we will discuss is known as the institutional candle or the institutional funding candle, or IFC for short. For beginners, the institutional candle is an outstanding concept associated with the market liquidity and price action. In addition, it is also a standalone powerful trading strategy that is followed by many SMC traders and price action traders. So in this video, we will talk about what an institutional candle is and why do these IFC candles form. We will also find reasons as to why these IFC candles work in the markets and why is it important for traders. And finally, we will also learn how to take trades using this concept. So make sure to watch the video till the end to get the complete understanding of the entire concept. So let's get started. The institutional funding candles are represented as the last opposing single or multiple close candles before the market forms a strong directional move. Those late buying or selling candles with one or more candlesticks within them which runs out of liquidity before heading in the intended direction are referred to as institutional funding candles. These candles simply indicate that the institutions sell before buying and buy before selling. And that is the reason why these institutional candles are also called banker's candle. So it is one of the most popular smart money trading concept out there. Basically, it is the manipulation phase, or we can visualize it as a tricky area where the big banks and institutions manipulate the market for liquidity. So if you remember, I have already talked about the AMD concept of liquidity in the episode about inducements. You can go back and watch that video to get a detailed understanding about the topic. But to brush things up, the AMD concept, or accumulation, manipulation, distribution, is a three-step process which involves hunting the retailer liquidity in the market by inducing these ill-informed traders to buy or sell at the wrong place at the wrong time in the wrong direction. This IFC concept is one of the popular manipulation techniques used to absorb the retail liquidity. You can easily identify this institutional candlestick pattern in charts with your naked eye.